Welcome to Impact Capital Forum's webinar series. Very nice to have you all here, and we're very excited to have our panelists here as well. For those of you who are new to the organization, Impact Capital Forum has been around for over 15 years, putting on events for the education, collaboration, and thought leadership in the areas of impact investing, microfinance, and social enterprise. We've been mainly doing in-person events, but are very excited to have started the webinar series recently. And we encourage you to visit our website to have a look at the next 5 webinars coming up on topics relating to, yes, the coronavirus, but also climate change and financial literacy. And that website is www.impactcapitalforum.org. For today's event, it's called Leading Investors Are Guiding Corporate Behavior During the Pandemic. We have an exceptional panel led by Bhakti Mirshandani. The panel will discuss a pact essentially signed on by 195 institutional investors to help guide corporate behavior during the time of the pandemic and minimize the negative impacts of that. So you'll hear about that and also big picture about stakeholder capitalism as well. Bhakti is an MD at FCLT Global. It's a think tank that encourages businesses and investment firms to think for the long term. She's also an adjunct teacher at Columbia, a frequent writer for Forbes, and an advisor to Corbin.
Great. Thank you so much, Scott. Coronavirus is the greatest problem of our time. It's the leading cause of death in the United States, passing heart disease, and there are 22 million unemployed Americans since President Trump declared a pandemic 4 weeks ago. Within 4 days of New York shutting down all non-essential businesses, Domini CEO Carol Leibel, ICCR CEO Josh Zinner, who we're honored to have both as panelists with us today, and New York City Comptroller Scott Stringer were leading a coalition of institutional investors and service providers to take 5 critical steps to protect society and workers. Their call to action captured the imagination of 286 investors with over 8.2 trillion in assets. So really impressive thinking on the spot and driving real change in a short amount of time. They are moving markets. Since the coronavirus pandemic, employee health and safety and labor practices have quickly risen to the top of ESG issues that sustainable investors consider. Mark Popovich, who leads the Good Companies, Good Jobs initiative at Aspen Institute, has worked tirelessly to create the business case for corporate support of lower wage workers. He found that employees who have benefits, good wages, and opportunities to advance are more productive and stay in their jobs for longer. Let's turn to each of our panelists in turn to share why they chose to get involved with the investor statement on coronavirus. So let's kick off with Carol.
Sure. I apologize if there's any background noise. I have young adult children, so I can control them, but I can't control the neighbor's landscaper. So if it gets to be too much, let me know and I'll pass to somebody else. So I'll just start off by saying, Domini, we have 2 fundamental underlying goals to our impact investment standards. And those are universal human dignity and ecological sustainability. The reason that we have those in place is that we understand that building a strong portfolio requires more than just looking at the numbers. So it's really important to remember that our investment portfolios today are building the world that we live in tomorrow. And when considering that, then we realize that it's very important to balance short-term efficiencies with long-term resilience. And that is really what's at the heart of the matter with this investor statement and what we're aiming to address with companies.
Should I go ahead, Bhakti?
That would be super.
Yeah, hi, I'm the CEO of the Interfaith Center on Corporate Responsibility. Some of you may know us. For those that don't, we are a coalition of over 300 institutional investors, faith-based investors, and other aligned investors who engage companies that they own on environmental, social, and governance issues. Our organization, our coalition goes back to the early 1970s when a group of faith investors began engaging companies on business they were doing in apartheid South Africa and really pioneered the strategy of shareholder engagement on environmental and social issues long before there was ESG. And so our main strategy, as it has always been, is shareholder engagement on fundamental ESG issues, climate, human rights, health, a whole range of governance issues. We are in dialogue with hundreds of companies a year. We file shareholder resolutions. We're involved in many multi-stakeholder conversations. And when the coronavirus epidemic hit, it became very clear to us and many of the allies that we work with that we had to take quick action to really push some level of accountability for companies based on a whole range of issues, including the way that they're interacting with their workforce. And that was a basis for us working with Domini and the New York City Comptroller and others to get the statement out really as quickly as we could to global investors.
Great, thank you, Josh. Mark?
Hi, Mark Popovich. I wish I was an investor or an institutional investor or a service provider so we could sign the statement, but we're really not in a position to do that. I'm at the Aspen Institute, founded in 1949 in Aspen, Colorado, to focus on big issues of the day. They use dialogue, leadership, and action agendas to try to move the needle on the most challenging issues of the day. I'm within a policy program, in addition to the leadership programs and things like the Ideas Festival, which are well known. The policy program that I'm with is the Economic Opportunities Program, which focuses on connecting people to quality work, starting businesses and building economic stability within the framework of giving people opportunity, particularly low to moderate income people in a changing economy, and we are certainly in a changing economy. I've been interested in working on the role of business in society for a long time, going back to a dozen years with the Hitachi Foundation, where we did a lot of work on business social responsibility, then impact investing, and looking at how businesses could do well and do good. I was very interested in the investor statement in two primary areas. Maintaining employment, which is going to be a huge challenge, but so important in this current crisis and the aftermath of the crisis, particularly around quality jobs. We've seen in the last 20 years a shift in GDP from pay to workers to higher corporate profits that reduce the percentage of GDP going to workers as employee compensation by about 4 to 10% of GDP, a shift of $1.5 trillion a year away from employees into corporate profits. I'm also interested in the paid leave provisions. It's become more common, thank goodness that we're there. We're about 75% in 2019, but it's least common among the lowest paid. The lowest 10% by wage get about 1/4 of them get access to paid leave, and yet many of them fall into this hero worker kind of category that we talk about today. And within that, of course, people of color are the least likely to have paid leave access overall, with, for example, Hispanics lower than 10% lower than whites. So those particular issues stood out in the investor statement, and I think are particularly important for us to get through the current time and have a better setting for workers and as well for companies when we get on the other side.
Thanks, Mark. Carol, we've spoken kind of high level as part of the introductions on the coronavirus investor statement, but it would be great for you to go one level deeper and explain kind of more about what it is and how it came to be.
Sure. So I'll start off, how did it come to be? And I'll just give a brief intro on Domini. We are an SEC registered investment advisor. We have about $2 billion in assets under management, and we are exclusively focused on products for responsible investors. So we have 3 mutual funds under management. All of them apply social and environmental criteria in the investment process. But another important pillar of impact is engagement. And our director of engagement approached me shortly after, I think when all of our worlds changed pretty abruptly, and we had instituted remote work arrangements, and she called me and said, you know, I think that we have the opportunity here to put out a statement to really help model for corporations how we'd like to see them respond in this crisis. And that those companies that are really bold and forward-looking can use this as guidance for how investors think we'll all be best served, because if we all work together to help mitigate the worst of the effects of COVID-19, we'll certainly recover from this crisis much sooner. So the statement, you know, was Corey's passion, and then we were, as you mentioned earlier, very fortunate to work with close allies of ours. Josh is here on the phone with us today, the Interfaith Center for Corporate Responsibility, but also the New York Comptroller's Office with Scott Stringer, which, so working together, you know, we built this statement with 5 recommendations that would help us to really move beyond the crisis and into recovery sooner. And the first was providing paid leave, which Mark was just touching on. You know, social distancing is just not possible if people can't miss work. So providing that paid leave so people can stay home and you know, all of us stay home and work together to get beyond this. The second recommendation was to prioritize health and safety. So for employers to think about opportunities for remote work or additional safety or PPE, you know, the protective, personal protective equipment for essential workers, it would be really critical. The third is maintaining employment as much as possible. So laying off workers leaves them without benefits. So in the midst of a health crisis, to have a workforce without medical benefits would be quite challenging. And then fourth would be to protect the supply chain. So we've seen some difficult situations arising within the apparel supply chain where certain brands are canceling contracts. That's leaving suppliers and their workers with money that they've invested to produce goods, but no compensation for it. And that has a ripple effect through the entire economy. And really, if you think about it, at the end of the day, it makes it difficult for those factories to start back up again when we are all ready to get back to work. So having that intact value chain is going to be essential for companies to resume their operations. And the fifth recommendation was to exercise fiscal prudence. And there we suggested that might include, during this time, limiting share buybacks and reducing executive compensation. So we drafted the statement in early March. It did, as Bhakti, you mentioned earlier in the call, it saw really immediate success. We had, I think, Scott mentioned early on the 195 signatories. That was in the first week. There were over 190 signatories. But since then, the statement has grown as people continue to sign on. We now have over 300 signatories representing more than $8 trillion in assets under management. So I'll pause there. See, Bhakti, did you want me to go into any more detail on any of the other points or pass it over?
That's great framing for the rest of the discussion. Thank you. Josh, what can you share about plans to implement the investor statement and early learnings from implementation?
Yeah, thank you, Bhakti. So there's a growing coalition of investors and NGOs that we're trying to convene on this. So ICCR is leading this along with Corey Clemmer at Domini. And we're trying to really bring everybody together to coordinate collaborative engagement across sectors, using the statement as a set of principles to kind of open the door and start conversations to engage companies more deeply. And there's kind of, there's a couple things worth mentioning. One is that the statement obviously speaks to the COVID-19 crisis and what the expectations are that we have as investors of companies. in terms of how they interact with their workforce and suppliers, and as Carol laid out, and how in their financial behavior. But also we see this as laying the groundwork for long-term policies that we expect companies to take. So the first layer is, how are you reacting to this crisis? What measures are you taking? Are you retaining workers? What are your paid leave policies during this crisis? But the expectation is obviously that this is going to be part of a longer term conversation. And it's interesting because, we ICCR members and our allies have been talking to companies about, for many, many years about why the fair treatment of workers is fundamental to building long-term value for companies. And it may be that this crisis cracks that door open a little bit. As a colleague of mine said the other day, we may no longer have to make the case to companies why fair treatment of workers is material to investors and companies. And also, I think that it does also present an opportunity for us to speak as investors to companies about systemic risk. Companies always want to focus it on, well, what does this have to do with my bottom line? Why does putting in place worker health and safety measures in my company impact the bottom line? And I think this crisis will open up a longer term conversation with companies about why ensuring the health of the economy more broadly is also fundamentally important to investors, and should be to companies as well. And also, just in this moment, there's the height of reputational risk, or the level of reputational risk to companies that behave badly in this crisis is heightened immensely. So it creates some levers for engagement, and so we have a large group of investors involved, engaging with sectors, engaging with companies. Sectors include, but many sectors, but food and agriculture, meat processors, restaurants, tech, especially around surveillance issues and implications around human rights there, banks, pharma, apparel, hotel, airlines, just to name a few. So there's a broad group of engagements that we're just getting mobilized to do. And there will definitely be a focus as well on governance issues. We can talk about that perhaps a bit later. And finally, I think one thing we're talking about is companies that are going to receive corporate bailout money through the CARES Act, and a need for us to remain vigilant in engaging companies around that, given how little accountability is built into the actual act itself. So, what companies are getting bailout money? How's that money being used? Is it used for worker safety, or for wages, or what are the layoffs at a company, or is the money being used for share buybacks? So there's also going to be a lot of focus and engagement on that set of issues as well. And I'll stop there. We can pick up on some of that later.
Thanks, Josh. You made some really interesting points about no longer needing to make the business case for human capital. It would be great to hear from Mark some of the data points that you've curated over your career on that business case.
Well, I also want to start off by saying congratulations to Josh and Carol and their partners in putting this together, because after spending a long career in the public sector and in the nonprofit and philanthropic sector, those sectors really follow more than lead the for-profit sector, and getting investors behind a push in this area to incent the right behaviors by businesses is so important right now. And this leadership was at a critical point, and I applaud what you've been able to do here. So we've all heard, and I think everybody who goes to CEO camp must be trained to say our people are our most important asset. The problem has been that so few act in that way when it comes time to make a decision that cuts one way or another. So, I mean, from my perspective, if you've been spending so much money in wages, benefits, orientation, training, those are all major investments. Are we going to grade that business on how they minimize those expenses or on how they get real return from those investments? What we've looked at is a study over about a 5-year period where we were looking at companies who were small to medium-sized companies, because you could see more of what was going on across many different sectors. It was called the Positive Deviant Active Research Strategy, where we were looking at companies in manufacturing and in healthcare and in retail and some services. And we were looking at companies only identified because they were simultaneously doing well and doing good. Doing well in terms of outperforming their peers, in terms of business and financial return, and doing good specifically in our case because their frontline workers were also outperforming in terms of better benefits, better pay, better working conditions, and the rest. And what we found there was sort of the 3 Ps: product, process, and people innovation. And you don't have that innovation and a move up in terms of value added unless you can put those 3 pieces together. And the people part of that is so important. And what we found is that the people innovation part of it usually followed and was really connected to the KPIs of the company. And that's when the company took it seriously and went the furthest and the farthest with it. So in addition to sort of that evidence around it, I think there's the sort of philosophical underpinnings of this, and that is the license to operate. We've got public faith in institutions lagging. It'll probably continue to lag and take a big hit during this downturn. Right now, a majority of the Edelman Trust Barometer respondents in 2019 in every developed market said they don't believe they'll be better off 5 years from now than they are now. And 56% globally believe that capitalism in its current form is doing more harm than good in the world. One of the reasons is specifically around the influence of companies on the employees there. When Just Capital does its polling to the public polling around what's the important things that companies should be held accountable for, 4 out of the 5 top public issues are related to people, and the 5th is ethical behavior, which you can certainly assume is connected to people as well. So if you look at performance over time, there's a Harvard Law School Investor Responsibility Research Report that looked across 92 studies. Bhakti, you cited this recently, on the relationship between HR policies and financial outcomes, and concluded there was sufficient evidence of human capital materiality to financial performance to warrant inclusion in standard investment analysis. I've been working for a number of years and as an advisor externally to the Heron Foundation in their development of the U.S. Community Investment Index. That's a positively screened fund of public companies. 30% of that is weighted on human capital, and the measures include both within firms and for suppliers, looking at pay and benefits, work-life balance, training development, equal opportunities, and they're outperforming. Compared to the Standard & Poor's Index year to date, they're 1.8% over performing a year, over a year, 4.2%, 3 years, 2.4%, 5 years, 1.7%. So I also looked at some data from Just Capital. There, they take the Russell 1000 and rate them on their criteria, and their top quintile of companies is outperforming the bottom quintile of companies by 465 basis points year to date. So we're seeing this trajectory of change, and we see this performance of companies that can be attributed to their doing the right thing with their human capital practices.
Thanks, Mark. That's really helpful context for everyone on the call, and really enlightening for me. Josh, you spoke in your comments about the crisis cracking the door open. Could you please highlight corollary efforts in the investor community, such as efforts to encourage collaboration among pharma companies? There are really so many interesting things that are going on.
Sure. Yeah, and cracking the door open is a hopeful way of putting it. These conversations are very early on, but we see a lot of investor interest in these conversations and a lot of public pressure. So So again, I don't want to overstate the hope because these are very difficult conversations. But a group, ICCR has a group of members that have been engaging with pharma companies for many years and have started a conversation with companies around the COVID crisis, specifically sending a letter to 14 pharma companies 2 weeks ago directed at CEOs regarding access issues and regarding companies' collaboration and financial prudence. So it really, what this crisis has done, not surprisingly, is it's revealing a lot of problems with the pharma business model as it relates to public health. So, with the limited focus by the pharmaceutical sector on critical life-saving medicines like antimicrobials and vaccines that are vital to human health, and it's a really short-term, profit-driven vision. And so, what the letter is asking the companies to do, and again, this is really the basis for ongoing engagement, is to share. I won't go through all the ask, but just to summarize, to share compounds, assets, and data with researchers, to accelerate the development of treatments and vaccines, to widely register their products as candidates for diagnostics, vaccines, and medicines, to support government decisions to issue compulsory licenses, which are really critical to ensuring affordable prices, in which pharma companies are usually fight tooth and nail, to issue voluntary licenses, to commit to manufacturing and supply chains that can be scaled up as needed to meet the shortage, and also to advocate for policies, including the call for global pooling of IP rights on COVID-related technologies, which is going to be so critical to getting the cures and vaccines out on scale, and which again goes against sort of the nature of how the industry operates. And more broadly, the ask to companies is to operate with financial prudence along the lines that we're talking about, and really to commit to a long-term model of real research and development and protection of workers and the like. And so that there's a like group of investors that we're collaborating with through the PRI in Europe, and we're really trying to broadly engage the sector as investors to make the case why how this is really critical to a sustainable business model for the sector. I'll stop there. There's, I should say there's a lot of other corollary efforts by investors, and maybe that's such as around supply chains in the apparel industry and others, and can get into those later or the next webinar.
Great, thank you, Josh. Carol, you've been at the cutting edge of sustainable investing for 23 years through your work at Domini. From your broad and deep perspective, how, if at all, is the COVID-19 pandemic likely to affect the trajectory of sustainable investing and investing in general?
Yeah, so I think we often find that crises are moments when change becomes possible. So if we look at our behavior, we see that we were all able to make dramatic, abrupt changes in our behavior to respond to the crisis. And, what we find is that systemic meltdowns, such as, the pandemic and the global financial crisis, investments across all asset classes are affected, and they're virtually non-diversifiable. There's nowhere to run and hide in your portfolio. So, and Josh had touched on this earlier, all investors are tied to the health of our societal, environmental, and financial systems. So for the well-being of our portfolio, we should be focused on safeguarding that value, and we should be thinking about the system. So right now, I think as an immediate response, we're focused on the social aspect of the crisis, so workers, suppliers, communities. But I think what we're touching on here is there are also big environmental lessons to be taken as well. And I think you're beginning to hear more of that now as the days go on. The first to think about is that this disease, like most emerging diseases, is likely partly attributable to the result of deforestation. The risk of this novel virus is just one example of the huge risks that are presented by continued environmental degradation and biodiversity loss. So protecting those natural systems is vital to all businesses, creates vulnerabilities that they may not even have considered in the past, which I think is something we all find ourselves thinking about these days. So it's, you know, illustrative of how important it is to focus on system risk in your portfolio. But also, secondly, I think this crisis has a lot of parallels to climate change, but is different in a way. There's a new term that's now been coined, so I think we're all familiar with the black swan description, but now related to climate change, there's a new coin called gray rhinos, which is that we have been warned that this crisis is coming. We've been warned that there are going to be likely severe effects, but we've largely chosen to ignore them. So I think when we talk about the trajectory and what's going to change in sustainable investing, but even investing in general more broadly, it's going to be focused on that system health. Because if we can learn from this crisis that investing in systems, so thinking beyond just a security or even our portfolio to the well-being of the overall systems, it's really going to be for the well-being of our portfolio, because I think we've all learned that the cost of dealing with a systemic breakdown, once it's in place, is much higher than preparing for it in advance. And in addition to that, you know, I sort of started off, and I think is worth pointing out again, that we have proven that we can move dramatically and swiftly when necessary. So as sustainable investors, we're all going to be saying, what swift, dramatic action can we take to get where we need to be? So sustainable, and I think even general investing going forward, I think is likely to enhance their focus on the health of those three critical systems: societal, environmental, and financial, so that we can avoid those non-diversifiable risks, enhance our resilience, which is really going to be a shift away from efficiency, rather, to invest in resiliency, and to recognize and protect the value of those critical systems that we rely on. I think that's the trend we're going to see going forward.
Thanks for that tremendously broadening context. It's really, it'll be really interesting to see how investors approach climate change in the face of such a substantial systemic breakdown. Mark, you spoke about the trajectory of trust in your earlier comments. Could you please share about trends in the trajectory of high quality and poor quality jobs and the long-term impact of the coronavirus pandemic on them?
Well, social and economic resiliency is, as Carol was mentioning, very much on my mind as well. I mean, if you pull back and take a look across the landscape, we came out of one of the longest economic expansion in U.S. economic history, certainly in the post-World War II era, and yet we had 60% of the population not much benefit, and in some cases slide back down even during that economic recovery of sorts. It was not broadly shared in terms of the benefits, in terms of improved quality of life or earnings or wealth generation. And now we have to say, will the slack labor market depress wages and benefits, and again foment the shifting of risks from employers and other parts of society back to families and individual workers? Coming out of the recovery, we still had 61 million people in jobs that were in occupations with median wages below the living wage. That was primarily In sales and retail related, 16 million people at median wage of 27,000, 15 million people in food preparation and serving at $22,000 a year median earnings, 11 million workers in transportation and material handling at under 32,000 median earnings, and 7.7 million personal care, elder care, developmentally disabled, all median wage under 24,000. And that last category, personal care, is, according to the BLS 2028 forecast, going to be among the fastest growing categories of workers in our society. And at my stage of life, I worry that we have those workers available and that they're being paid and treated appropriately. We have huge losses of jobs already that we're seeing in those first three categories. And we're not seeing any growth in the larger the better categories of better work occupations. In the first, in March, we lost 700,000 jobs. 460,000 of those were lost jobs were in hospitality and leisure alone. 460,000 of the 700,000. We've also seen large drops in retail trade and some actual net loss in healthcare as well as social assistance. So we're seeing that based on one of the Columbia University research studies, that if we hit that range of this year of 20 to 30% overall employment, we'll see a poverty rate rise from about 10% to about 15%. In that scenario, what rebuilds consumer demand? Consumer spending accounts for about 70% of US economic growth. And you have to wonder where that's going to be coming from. I mean, government is going to have to be doing something, particularly the federal government, to prime the pump, but businesses are also going to have to maintain employment and rebuild employment in quality jobs on the other side of what we're facing right now.
Great. There's still so much richness to unpack with our phenomenal panelists and the groundbreaking work, but let's pause and give the floor to attendees to ask any questions they may have. Are there any questions from the floor? Okay. The first question is from Mark Tenuth. Given the collapse of oil prices and volatility around energy partially caused by COVID-19, do you think the crisis will be an opportunity to accelerate the transition away from fossil fuel, and what could that look like?
So I'll step in and say, I think we can all be hopeful, but with the collapse of oil prices, I think we've all been hearing about how all the storage containers are full to the brim, and the reason oil is so cheap is there is no place else to store all the oil. So they can, pretty much stop pumping, but there's certainly quite a bit out there still. I think a lot of the reason, if you think about the demand, so we tend to rely on natural gas for electricity and chemicals, but for oil, with the slowdown in airline travel and factories, I think is where we're seeing the fall off. So I would certainly love to see that this is the time that the shift is going to happen. I tend to think the shift will happen more from the lessons learned here than the collapse in the oil prices, but I always like to be hopeful.
The next question is a technical question, and that's for Mark from Dr. Jillian Marcel of Resilience Capital Ventures. Can you provide any reports on the labor market stats that you referred to?
Yeah, sure. I'll bring together the links, and who should I send that on to? How can we distribute it, or she can write to me directly, and I can send those on to her.
Perfect. Thank you.
Mark, Impact Capital Forum will distribute links from the speakers after the event.
Oh, great. That's perfect. Thank you.
So I don't see any more questions from the floor, so we'll move on to a couple of other issues that the panelists can speak to. Josh, from your perspective, will the pandemic accelerate the transition from shareholder primacy to stakeholder capitalism, or are the changes likely to be temporary?
Well, one would certainly hope, that you couldn't have a bigger wake up call as we've talked about. So if there were ever a moment to accelerate that shift, this would be it. I think evidence from the 2000 financial crash that extreme events would lead to a change in company behavior. I think we certainly didn't see that with the financial sector post 2008. So I think that there is the potential there. I mean, as people know, the Business Roundtable put a statement out a year ago, on paper moving from shareholder primacy to stakeholder capitalism. And I think while many of us in the field recognized that was a step forward, I think also most of us viewed that with certain skepticism, not least because many of the signatories were saying, well, we're already practicing this. And in fact, we're still heavily, lobbying against sound environmental rules and sound labor rules and sound financial rules, all of which would benefit the stakeholders that they're referring to. I think this crisis, if there's hope to be had, that it might create some changes in certain structural corporate governance structures. There was a good article last week, I think, in the Times by Judge Leo Strine, who writes a lot about these issues and was the chief judge of the Delaware Supreme Court, talking about how despite record earnings the past decade by companies and of course the huge corporate tax break that came in the last couple of years, that companies are still very highly leveraged, as we know, and we're now seeing that there's very few cash reserves that companies have to weather this storm, and it really highlights very short-term policies by companies around share buybacks and dividends and runaway executive compensation with misaligned incentives. And it's interesting because, of course, the biggest investors in those public companies are holding the retirement savings of US workers who are really suffering because of those short-term policies. And this COVID crisis really highlights the inequities as workers and in particular lower income workers and people of color are disproportionately impacted by the crisis and really facing the brunt of the harms both now and unfortunately going forward in the future. And so if there is going to be a shift, however gradual, towards stakeholder capitalism, there really needs to be a fundamental shift in governance structures at corporations to really bring a focus on financial prudence, on fair treatment of workers, as core to company value, to building long-term sustainable value. And this needs to be supported strongly by public policy, which, maybe in the moment we're in now seems like a long shot, but maybe the shock of this crisis will move us towards more sound public policies. Maybe companies that take bailout money need to convert to a public benefit charter. There's different ways of thinking about this that could accelerate a shift. So I don't want to be pessimistic and say, well, we've seen before that shocks like this, and extreme events like this, at the end, companies go back to the same short-term ways. But I think we need to think creatively about, if there is a true shift to stakeholder capitalism, what does that mean? And fundamentally, one last thing I would say is that what it can't mean is that companies continue to engage in public policy in a detrimental fashion. In other words, lobbying, particularly through their trade associations, for policies that are beneficial to companies in the short term, but are highly detrimental to both the public and, frankly, to investors and beneficiaries who are concerned about systemic risk.
Great. Hopefully, we'll be pleasantly surprised by corporate and investor behavior, and I guess your investor coronavirus statement is part of part of that push and all of the different efforts that are continuing. Mark, have you seen evidence that companies that abide by the suggestions of the investor statement are outperforming, and would you be able to share those with participants?
You know, I cited the year-to-date results for the USCII, and I think we need a little bit longer to see this level of crisis, whether the performance of those companies continues to outperform other parts of the index or other parts of the rating system. But I expect that they will. In some ways, I think I've experimented in the past with using the different criteria that have been used to select companies kind of on a broad ESG basis, turning off any two of those and keeping one of them going. And you kind of come up with a similar list of companies, whichever two that you turn off. And in some ways, I think what it means is that it's a good test of good management, and that good management will outperform, taking that perspective, people who are not taking the perspective of the intermediate to longer term. So I think the other thing to think about is in 2008, the crisis came very late in a national election process, very late. This is happening much earlier, and believe me, this is unfolding at such a rapid pace. We've never gotten to 22 million people filing unemployment insurance this quickly. It's going to have an impact in the fall, and I do believe that companies who are viewed as good companies legitimately for doing the right things are going to be in a different position than and be able to lead on change than companies who have perhaps put out statements about what they were going to do, but didn't follow through on that in terms of walking the talk in the current circumstances.
That's really interesting context to share. We suddenly have a lot of questions from the floor. The next one comes from Vincente Escriva. Given the myriad number of certifications for responsible business and the vague nature of the Business Roundtable statement, how do you discern the validity of any given company's corporate responsibility?
I can step in. So typically our approach is to focus on trends and patterns over time when we're looking at companies, and to really be focused on what their core business is. So we look at key performance indicators, which we think about addressing the key sustainability challenges that they face in their industry. And that's really how we try to sift through and differentiate through the noise. So I think it's always helpful to give an extreme example. So for example, if we're looking at a large financial institution, it might be interesting to know what their in-house office recycling program is. It helps us to build a sense of their corporate culture and their commitment to the environment, but it's certainly not going to be what we base our decision on. We're much more keenly focused on their access to capital initiatives, how they treat their customers, how they charge fees and expenses, and overall how they manage the risk in their business. So I think that's helpful. You know, the kind of two key questions of what is the core business that you're in? How closely aligned is that with our goals of universal human dignity and ecological sustainability? And how do you treat your partners in business?
Thank you. We have another question from Dr. Jillian Marcel from Resilience Capital Ventures, and this one's directed to Josh. Would you recommend a focus on advocating for a shift in governance structures at the company level or at the institutional investment level, their sources of capital, and does this vary between public and private markets?
No, I think absolutely. I think in our engagement with companies, always, you know, that's the G in ESG, that, you know, there's a focus on strong corporate governance, and we see that as increasingly. It's always been a critical component, but increasingly critical here. When we're looking to companies to make a fundamental shift in the way they're thinking about their business model and the way they're doing business, that's got to come from the top. And if there are governance structures in place that are promoting short-termism, as you know, as several of us have talked about on this call, then that's not going to be a genuine change by the company. So it really does start with good governance structures, and so that's fundamental in engagements with companies. And I think that cuts across both public companies and private as well.
So Carol, if investors on this webinar like what they hear about the investor statement, how can they support the work?
Yeah, so we'd love to, like you say, come into the water, it's warm, review and join on to the statement. You can find it on our website at domini.com/COVID-19-statement. You can also share the statement with businesses you invest in. So let them know how important it is to address stakeholder concerns right now, especially in the moment of this crisis. Not only for their own operations, but also for the sake of the markets in general, which will help them to recover sooner as well. And then I guess lastly, I would just appeal to investors to think about how their investments affect the systems that we all rely on. So that really integrating that systems level thinking and carrying that into both their investment portfolios, but also their engagement strategies as a way to help us make the changes that we all desperately need to see right now.
Thank you. We have time for a couple more questions. Since there are none from the floor, Josh, maybe you can share your perspective on whether this moment calls for broader thinking on what constitutes fiduciary duty for investors.
Yeah, I think that's a really good question. You know, this is not just about corporate responsibility. This is obviously about investor responsibility as well. And, you know, the corollary to the shareholder primacy doctrine is, you know, that fiduciary duty, you know, under fiduciary duty, pension funds, for example, are supposed to operate for the sole benefit of their beneficiaries, and how the law interprets that essentially as that those pension funds should operate in maximizing returns for investors. You know, so that feeds the shareholder primacy model. And I think this COVID crisis does create both an opportunity and an urgent need to rethink the notion of fiduciary duty. And, you know, this is going to take public policy shift as well, but why should fiduciaries not also be required to look at systemic harm? You know, and Carol was speaking about this earlier. If there are behaviors by corporations that are impacting the health of the economy and thus markets overall, that's problematic for investors, and therefore that should be factored into fiduciary requirements. So, for example, tax avoidance might be profitable for an individual company, but on a systemic level, it's highly problematic. Pollution, you know, an externality, you know, it's profitable for one company, but a real problem for the system and also for those beneficiaries. Worker health and safety in a pandemic, you know, that's, you know, right, it's, you know, something we've talked about today. Also, that can be a really systemic issue. So that the rethinking of fiduciary duty should absolutely extend to systemic harm, and not just you know, maximizing benefits in sort of a narrow frame. And I think we should also rethink fiduciary duty also in terms of harm to beneficiaries. If a company is polluting waterways and that's creating harm for beneficiaries of that retirement fund who live in that region, shouldn't that also be factored into fiduciary concerns? So just to give some examples, I think it is really, really important for us to use this moment to rethink the notion of fiduciary duty. And again, just to emphasize, this is very much about investor responsibility as well as corporate responsibility. And investors really need to focus on what they're pushing companies to incentivize.
Thank you, Josh. We have a couple more questions from the floor. The next one is from Elizabeth Marshall. What about companies whose COVID-19 response exposes problems in things like their treatment of workers? Will there be consequences?
Yeah, so I do think that as investors evaluating company behavior, we would certainly take that into account. I think we're mindful that corporations aren't perfect, but what we're looking for is, on balance, that they're addressing their key sustainability challenges. So we would look to see that they're giving a thoughtful response. And I do think that this crisis is going to expose some weaknesses that they have. And then at a time of crisis, you know, how do they respond to that positively or negatively? And that's sure to have consequences for them, not only at an investor level, but I think also, as Josh, you were pointing out earlier, a reputational level. So their corporate identity.
Thank you. So we have 3 minutes and one last question. So we'll have a lightning round of answers before thanking all of our panelists for this fantastic discussion. The last question is from Dr. Jillian Marcel from Resilience Capital Ventures. Again, lots of great questions. Low-income workers and people of color are disproportionately affected in the COVID-19 crisis, but they're least likely to be engaged or involved in shifting the behavior of corporates or investors. How can the social distance be mitigated?
I can give one response and maybe we can go around. I mean, we feel like it's really, really critical for investors to be working very closely, not to just be in a bubble talking to companies, and for investors to be working very, very closely with labor groups, with community-based organizations, and with nonprofit organizations, NGOs, really to understand what the impacts are on the ground, to make sure that corporate boards and executives are hearing the voices of people who are impacted. And I think that's really a responsibility that investors have to create that bridge. And that's certainly how we see our work and a fundamental aspect of the engagement that we're all doing around the COVID crisis. It doesn't solve the problem, but it's a role that investors need to play to make sure that some of those voices are heard and understood by corporations.
Yeah, at Domini, we think about diversity as a universal key performance indicator, so really critical across all. And so that's important to us. And what we're looking for is we build diversity within companies. Those voices will be heard within the company. And then, as Josh was pointing out, when we think about building these coalitions to address these issues, we're really looking for that multi-stakeholder representation as well.
So just before I came on this call this afternoon, I was on another call that we organized at Economic Opportunities Program, which was with 3 folks who represented different parts of the worker voice, worker organizing efforts in the United States. It was a traditional union, a platform-based approach to careplaceworker.org, and then National Black Workers Center. And there's organizing, and there's an effort to bring that voice forward and to call to account folks who have not listened to what's been happening in these communities and not responded to it. And I think there will be a concerted effort to hold folks accountable.
Thank you, everyone. So thank you to our fantastic panelists, not only for a fantastic discussion tonight, but also for doing really groundbreaking and critically important work in these challenging times. Thank you for Impact Capital Forum for hosting us, and thank you to all of our participants for making this such a robust discussion.
Thank you, Bhakti, Mark, Josh, Carol. It's been a very engaging discussion. We will send out links to all the attendees after this. And in terms of the next webinars come up, please join us on April 29th, 3 p.m. about how microlenders and nonprofits are serving the New York City community during this epidemic. Have a good day, everyone.
Thank you.
Take care. Stay well.